Okay, hi there, welcome to a Year 13 macro video. We're going to spend a few minutes thinking about the analysis of and evaluation of a policy of trade liberalisation. So first of all, what do we mean by liberalisation of trade? Well, that involves an agreement between one or more countries to agree to lower the scale or the height of their import tariffs. An import tariff, of course, is a tax on imported goods and services, and it can also involve relaxing import quotas or any other form of non-tariff barrier or protectionism. Now, for supporters of free trade, argue that countries can then, as a result of liberalising trade, can then specialise in the goods and the services in which they have a comparative advantage. One of the aims of trade liberalisation is to make an economy or a cluster of countries more open to trade and investment so that they can engage more directly in the regional and the global economy. So, are there good recent examples of trade liberalisation that you might want to put in your economics revision notes? Well, here are three. The UK, having left the European Union, having left the customs union and the single market of the European Union, has started to sign free trade deals with countries such as Australia, New Zealand and Singapore. Of course, having left the single market, they are now free to be able to do that. A really important trade liberalisation agreement is the RCEP, the Regional Comprehensive Economic Partnership trade agreement amongst, I think, 15 countries, which brings down tariffs on about 90% of traded goods and services. Essentially, a whole cluster there of Far East Asian economies, including Laos, Malaysia, Brunei, Cambodia, China, New Zealand and Vietnam. And most recently, the African Continental Free Trade Agreement, the ACFTA, potentially hugely significant agreement, which is attempting to create a free trade area and a single market eventually of over 1.3 billion people by liberalising, by cutting over 90% of intra-African tariffs. In other words, those are the import tariffs charged by African countries on other African nations when trade takes place. A lot of trade liberalisation does happen at a regional rather than a global level. One of the features of recent years has been the difficulty in coming to truly global trade agreements. There has been, if you like, a shift, a movement towards regionalisation rather than multilateral trade agreements. And the RCEP is a really good example. 15 East Asian Pacific nations of very different sizes and also stages of development, very different levels of per capita income. The RCEP will become the biggest regional trade agreement in the world if you measure it by the combined GDP of the members. I think the RCEP is about 1/3 of the world's GDP, just under, in fact, 30.5%, much bigger, almost twice as big as the European Union, and bigger than the USMCA, the agreement between the United States, Mexico and Canada, which superseded NAFTA. So these are significant regional trade agreements that involve trade liberalisation. So how can we show the impact of trade liberalisation using analysis diagrams? How can we get great analysis marks for a question on trade liberalisation? Consider an example where there's a market in a country for beef and where the domestic price is P1 if there was no trade, but there is a world supply price of P2, but that a tariff has been applied to that price. In which case domestic demand is Q2, domestic supply is Q3, and the gap, Q3, Q2, is made up by imports. So if you get a question on trade liberalisation, don't just draw the tariff diagram. It's a reverse diagram, if you like. So with trade liberalisation, we are bringing down, we are lowering the tariff. As a result, we can draw a new world supply curve of beef with lower tariffs. And I've brought the tariff down so the price falls to P3. This now becomes effectively the trade price. Domestic and importers trade at P3 instead of P2. Well, this has consequences. Clearly, if prices fall from P2 to P3, domestic demand expands because of lower import prices. People will now be able to buy their beef more cheaply. But there's a counter-argument, a counterpoint, that domestic beef farmers, well, now they're getting priced P3 instead of P2. They may well contract their supply from Q3 to Q5 because they may not be able to compete at such low prices in the aftermath, in the wake of a trade liberalisation agreement. So how can we evaluate the impacts of trade liberalisation on economic welfare? Just going back a slide to the previous diagram, if you really wanted to, you could then show the effect of liberalisation using consumer and producer surplus. And I may well produce a short video taking you through that. That will be very high level analysis diagrams. You may not necessarily have the time to do that in an exam. So this diagram will be absolutely fine as part of a discussion of what happens to economic welfare. Let's think about some of the gains, some of the advantages, some of the positive spillovers from trade liberalisation. I suppose the obvious point to make is that for many consumers, prices would fall because the tariff on imports has come down, or the quota on imports creating artificial scarcity has been abandoned. So if prices fall for consumers, this therefore increases their real incomes or their real purchasing power, and they can have more consumer surplus. We'll try and show that in a separate video. And oftentimes lower prices has quite a progressive effect on inequality. You see, cheaper import prices could increase the real incomes of lower income families and allow them to consume more goods and services. So that might help to reduce inequalities in consumption. And from the business point of view, from the market point of view, trade liberalisation can make domestic markets and industries more competitive, or as we sometimes say, more contestable, because the import tariff ordinarily acts as a barrier to new firms coming in. Well, that tariff has fallen, so the markets now become more contestable. Prices will fall closer towards marginal cost, and that will improve allocative efficiency. The increased strength of competition can drive businesses to lift their productivity, to lower their unit costs. And also the trade liberalisation itself is often designed to encourage businesses to operate on a bigger scale, trade across borders more freely, more easily, benefit from specialisation, achieve economies of scale, and therefore improve productive efficiency. So there are pretty solid reasons for thinking that trade liberalisation can improve economic welfare. However, I think as part of your evaluation, you also need to be familiar with some of the possible drawbacks, some of the negative aspects, the economic risks, if you like, or downsides from liberalisation. For some countries, of course, particularly low-income countries, tariff revenues can be quite a sizable percentage of their total tax take. So if tariffs are falling, that's going to bring down, at least in the short term, the tariff revenue for one or more governments. And crucially, there is the risk of higher structural unemployment, particularly if consumer spending shifts away from home suppliers towards cheaper imports. And we know that structural unemployment is made worse when labour is both geographically and occupationally immobile. If certain industries, if certain regions suffer from liberalisation, that can lead to a rise in relative poverty or inequality. And there could also be a short-term rise in the size of a country's trade deficit because the price of imports has come down and the volume of imports will go up. Of course, this depends on the price elasticity of demand for imports, and that's worth mentioning in your evaluation. And there's also a kind of environmental aspect, that opening markets to trade can lead to some environmental costs. Perhaps you start trading more with countries with weaker environmental laws, so you might start trading toxic waste. The food miles that products travel might go up, leading to an increase in emissions. So trade liberalisation can give substantial economic benefits, but as part of your evaluation, it's important to know that these benefits may not, in fact they're never distributed equally. There could be some inequalities in the allocation of benefits. Another good evaluation point, particularly if you're writing this as part of a synoptic paper, is that trade liberalisation can have both micro and macroeconomic effects. The effect on inflation, effects on investment, the effect on trade balances, and ultimately growth and living standards. The impact really depends on how big are the cuts in tariffs. Often a trade agreement is made, but tariffs were fairly low already, so there wasn't a significant positive benefit. And it also depends crucially on the flexibility of domestic businesses to respond to the trade liberalisation? How do they cope with imports become cheaper? And the impacts of trade liberalisation can be very different for advanced high-income countries contrasted with low-income nations. Try to build that into your evaluation. Now, how can the concepts of trade creation and trade diversion be applied to the topic of trade liberalisation? Well, trade creation essentially means that countries agreeing to lower their import tariffs. That will stimulate trade between the members of a trade agreement. So we'd expect to see greater trade within the African economy as import tariffs come down. That's trade creation. Trade diversion is where lower import tariffs redirect trade away from non-members of the trade agreement towards participating members. And typically that might often lead to higher costs. It depends on the relative costs of countries that lie outside the trade agreement. So trade liberalisation, it's an important topic to know something about. It links to the work that you've done on trade theory. It's an important growth and development strategy for many countries. Crucially, I would argue that yes, trade is going to strengthen the links between countries and hopefully drive investment as well. Ultimately, trade agreements work if they result or if they lead to mutual gains for the countries involved. In other words, a better macro performance and net economic welfare. This is not guaranteed, but the regionalisation of trade agreements suggests that countries are recognising their mutual interdependence and the potential benefits and the value of freer trade agreements. So a key topic. Thanks for joining on this video. Hopefully it's cemented a few ideas in your minds and you can use this in your exam answers. Take care, stay safe, see you soon.